All right, good afternoon, everybody, to the Polaris Trading Group PTG University Education Series. Today's educational topic will be premium and discounts beyond theory. And what we'll do today is we'll take a practical application. We'll look at several examples of both premiums and discounts using the Russell 2000 contract TF. We'll highlight the good looking setups, the not so good looking setups. We'll discuss the filters, we'll discuss the structure, we'll review the definition to begin, and the idea of the various relationships between the moving averages. Okay. Okay, so in this next slide, this was taken from a prior workshop, and simply is how we define premium and discounts. All right. So before we actually get to the mathematical type definition, just a little review in regards to the dual auction pricing mechanism. All right. The dual auctions function, the market's function, is to facilitate trade. Simple as that. All right. IPOs are there to bring companies public. Once the companies are public, the market's function is to facilitate trade between buyers and sellers. All right. So with that, there's differing views of what is considered fair value, what's overvalued, undervalued. All right. Traders and investors, depending upon their time frame view, have different views of those various ideas. All right. So with that, we want to take a measurement of what is considered a short-term view, an intermediate-term view, a longer-term view of what perceived value is. Okay, and again, based upon a time horizon, that will vary. So what we want to do is we want to look at swing pivots. Okay, now these are swing pivot points, structural swing pivot points that define highs and lows, all right, throughout the course of the day. And we want to look for various progressions, all right, higher highs, higher lows, so forth. Again, this is all basic structure. And but in doing so, when we deal with our execution charts, not one particular bar itself is going to be an important bar. There's going to be a series of bars, okay? And within the context of multitude of bars, whether you're using a 144 tick or a 750 tick, depending upon the instrument's sensitivity, there is not really one bar in the mix of all those that's more important than the other. So what we want to try to do is we want to smooth out that action. And simply, a very common way to do it is use moving averages. Now, moving averages, a lot of people many times don't view it this way, but it's really, a moving average is a consensus of value. All right, it's an average price over a period of time. So the key moving averages we use in our work is the 13, 34.89, 233, all exponential because we want to weight everything to the most current period. All right, we don't use simple moving averages. And so simply that perception of value utilizing moving averages is one trader's GTFO point is another trader's opportunity. We all know what GTFO point stands for, right? So when one person wants to get out, and another person's looking for an opportunity there. So for example, a scalper or a short-term trader may exit a position at a particular price level that they no longer feel attractive, okay, based upon their work. Yet an intermediate person or a longer term, like institutional trader, will see that as a bargain price based upon their time horizon. So again, you've heard it before, value is in the eye of the beholder, right? Beauty is in the eye of the beholder. So collectively, the market's interpretation of value simply drives prices higher or lower. Now, the main driver of prices is what's referred to as the other time frame trader. i.e. the big money manager, institutional type account. Day traders don't drive the markets. Intermediate term traders may have some influence, but at the end of the day, it's the big mutual fund type investors that have the ability to move the markets in meaningful ways. All right, so since price value is a perceived notion, okay, we're going to define, we'll simply define it in terms of a relative position of price compared to the average consensus. All right, and that's simply where is price relative to the various moving averages that we look for. Okay, whether it's a 750 tick or 200 volume, as I said, it doesn't really matter. All right, so let's take a look at what the hard definition is of premium and discount. So simply just follow along with this here, more in a slight mathematical formula, but nothing too complicated. Simply a discount is defined, and again, these are defined as trending or directional conditions now. All right, so price is defined, discount is defined as a price less than or equal to the 89 EMA. Again, these are all EMAs. And the 34 is above the 89 EMA. And it's stronger if the 89 is above the 200 and the 200 is also sloping, okay, in the same direction. And or, so this is an important contraction, and or the CCI indicator, the SCCI line, which is the slow CCI line, right, is greater than the 0 line, and the fast CCI line is less than the 0 line, or the fast CCI line is less than the minus 100. Okay, so simply price is less than the minus 100, the fast CCI line minus 100, and it hooks back up. So the premium here is just the opposite. So price is greater than the 89 EMA while the 34 is below the 89 EMA. And again, if the 200 is above it and sloping down, all right, that makes it a bit stronger as well. And or on the CCI indicator, the slow CCI line is below 0. The fast CCI line is greater than the 0 line or the plus 100 line. Now, one note I want to make on these is that the angle or slope, right, of those moving averages is extremely important. Right, the steeper the slope, the stronger the directional conviction. All right, and in another prior workshop, we spoke about and presented the stacker trade. So the next note here is when you have stacked EMAs, which is 34 greater than 89 greater than 200, or the vice versa, 34 less than 89 less than 200, all right, with relatively steep slopes, that increases the strength of a signal. All right, so that's the core definition. Just let me in a moment, let me just set up the charts and we'll take a look at some practical applications. Okay, so what we're looking for is the on the TF here, 200 volume chart, and again, it could be a 200 volume, a tick chart. Everything that we're going to discuss is relevant to all various contracts. All right, so what we'll take a look at is we'll take a look at a series of premiums and discounts. We'll highlight some of the features of those premiums and discounts, and we'll take a look at what comprises a good one, all right, not so good one, and we'll see if we can gain some insights into how to practically trade these things. Okay. All right, so let's just take a look at a couple of the discounts. Now, what we have here is a strong trend up. Okay, so we have a directional move. All right, so that's the core part of the definition. And this white dotted line is the 13 EMA, followed by the 3489. And that shaded zone is referred to as the value zone. okay, as we describe the value zone. So this value zone is simply defined as the area between the 34 and the 89 EMAs. So that's that shaded area, okay? Now, what we want to be, some of the kind of the practical items about this beyond the definition is, when we have an uptrend going, so we'll focus on this discount. On the pullback here, as price is coming down into the fair value zone, okay, what we want to be anticipating, okay, and again, we don't want to be buying on the way down. What we want to be doing is we want to be buying that right side pivot rule, okay? So simply, as price comes down, okay, we don't want to be buying it on the way down, but what we want to be doing is we want to be preparing ourselves for the opportunity of a discount forming. Okay, so since we have an uptrend in effect with a price pullback, we're saying, okay, we're going to look for a discount within the context of this uptrend. Now, again, that's not novel in terms of buying pullbacks. Everybody knows that. The idea of the CCI crossover system, i.e. premium and discount, is that with the CCI, it offers us an opportunity to identify a statistically significant point in which price has pulled back deep enough where the probabilities begin to favor, all right, a reversal back to the primary trend. So as price moves back down, it reaches a certain point and then works its way back up. Okay, it's at that turning point, swing pivot. Okay, that's we're going to be looking for that discount. So the key is, well, where do we look for that discount? Where do we look for that? Where is the highest probability of a turn occurring? That's going to be, at or below the 89 EMA with the proper conditions. So the proper condition primarily is going to be the 34 above the 89 with a decent slope. So the slope of the 89 is nice and positive. You can see this is about a 30 or 40 degree slope up, okay? Again, visually. And then as price comes down to that 89, we want to be looking for that opportunity to start looking for a turn in price, okay? Now, the basic core method of entry, because we get a lot of questions about, well, how do you enter? Okay, so these are some of the practical approaches going to be based upon your personal trade plan. So let's just take an example of using the right side pivot rule. Okay, now the right side pivot rule is simply going to be looking at once the alert bars, all right, are formed. Now the alert bars are not trigger bars. They're alerts to tell us that the conditions are in place for a potential trade opportunity. Okay. What we've done here on the software is we've highlighted not only the alert bar, but we also put some text on here, all right, discount, DISC, with a reference price. And the reference price on a discount represents the highest price on the alert bar, and on a premium represents the lowest price of the alert bar. So you immediately have a pretty good idea of a level that you can at least consider, at or around for an entry. Okay, it does not have to be the entry price. It can be. All right, and it all depends how you're working into the trade. So, but what we want to do is, in anticipation of a discount forming, or we don't want to be buying them on the way down because we don't know exactly where it's going to stop. We have a pretty good idea. So at or below that 89 is a good location. So when we're looking at this from a practical standpoint, okay, as price is coming down, you can reference that 89, and also if you take a look at the indicator down below, all right, the CCI, what you want to be referencing here is you want to be as the fast line comes down below that minus 100 line. So once it's below that minus 100 line here, all right, you can start anticipating that as soon as it starts crossing back up through that minus 100 line, you're going to get a signal dot on the indicator as well as an alert bar with the text and reference price. These are painted in real time. All right, there is absolutely no delay. All right, but as soon as it starts painting on the bar chart, that does not mean you have to immediately buy it. Okay. We'll give you some examples of how to play that game. Okay, of entering, and whether you're all in and scale out, or scaling in and scaling out. Okay, so let's take that first example of all in and scale out. Okay, so first what you want to do is, as prices have come down and you're anticipating that alert bar to form, okay, you're looking for, and what we have to do, we have to wait, using the right side pivot rule, we have to wait for the alert bar to close. Okay, it has to be set in place. But what you want to do is, sometimes in this example here, sometimes you may get multiple alert bars, in which case you'll see the text kind of overwrites itself. That does not make it stronger signal, but it just means that the condition is still very valid. So what you want to do is, you want to reference the top of that alert bar, draw a line, do something, right? And then what you want to be looking to do is, you want to be looking to buy, once that alert bar is in place, you want to be looking to buy on the right hand side somewhere. Again, I'm putting a variety of markers in there because there's not a singular price. All right, and again, what we're trying to do is, we're trying to get an efficient price following the pivot. So once this pivot is put in place here, okay, we want to get a good price location, and that's going to be on the right hand side. And the reason why we want to wait for the right side pivot rule is simply, if this trade fails, okay, to fully develop, right, we know exactly what our stop point is. All right, so it's going to be strictly below the low. All right, and it's a relatively small risk level between the entry prices and the stop price. It's probably going to be no more than 2 points. Many times it's about 6 ticks. All right, but generally no more than 2 points. Now, if we execute it right. Now, if you're trying to buy it on the way down, you don't really have a stop point, because we don't know whether or not this particular case, price is going to stop, at or below that 89. But we have a pretty good idea that it will. Very simply, be patient. Wait for that alert bar to form, then you can start entering it. Okay. Now, all right. Let me just go to the next example. Again, we'll get to some of the other aspects of it, but I want to just kind of zoom in here a little bit. All right. Now, on this particular example, again, same thing. Price is moving higher. All right. Good, strong trend is still in effect. All right. We got a little bit of a pullback here. All right. And now, the low bar forms, so as price is coming down into that 89, that fair value zone, the fast CCI is below that 100. Again, you start anticipating that we're going to get a move back up on the CCI, and then that's where we're going to be looking for, again, the right side pivot rule. So from the low bar, you can kind of reference back a few bars back and just kind of draw a line there. Okay. Now, this is where it actually formed. All right, and again, that alert bar does not necessarily form on the low bar, all right, but it's going to be within the context of that pivot zone. All right, so in this particular case here, the alert bar formed, and then price kind of moved away fairly quickly. Now, in Russell, it can do that. Okay, S&P is a little bit, not as I don't know, active in moving away from a level. You have plenty of time to usually enter at or around that alert bar within the context of the alert bar. But here's the thing: if you miss an entry, in the sense that you try to use that right side pivot rule, it does not have to be the next bar or two. Okay. Many times what happens is, you'll see price moves up like it does here, then ultimately pulls back. And it actually pulls back to approximately where that alert bar for the discount. Okay. Now you can notice here, this is several bars later. Okay. This is still a valid entry. all right, point, as it pulls back here into the fair value zone. Okay, so even though you might have missed it here, I mean, you might have said, all right, I'll buy one or something right along there. Okay, if you missed it, it runs away a little bit, don't go chasing it. All right, we never want to chase something. You want to be within the context of that alert bar, very, very close to it. So the reference point here is 1135. So you want to be really close to it. Does that mean 1135, 20, 30? A few ticks is fine. You don't want to go running away, 10, 12, 15 ticks, because now you're giving up an edge. Let the market pull back if it's going to pull back. In this example, it did. All right, and then reestablish yourself, okay, roughly around that same point. Your stop is still going to be below the low. Okay, so there's going to be no change in the stop point. You're just going to be a little bit more patient. Now, okay, one thing I want to add here is that the 13 EMA, we refer to that as the lead line. Okay, it is best to have the lead line, in the case of a discount, all right, north of the 34, so 13 above the 34. Okay, and again, it's going to be a very sensitive line, so the slope of it's going to be changing, fairly rapidly. The key slopes are going to be the 34 and the 89. All right, you want to look to buy enter the trade within the fair value zone, and then you're looking to scale out. So if you entered, let's just say over here, all right, and your stop is, say, roughly 2 points. Let's use a 2-point increment here. Okay, your risk-free point is going to be plus 2 points, and you can use your position sizing algorithm for that. All right, that's included in the software, and you can, or if you just said, all right, I bought them at 1135, well, you know that 1137, is going to be your risk-free point if you're risking 2 points on the downside. Now, if it's 6 ticks, your risk-free point's going to be plus 6 ticks from your entry. So, let's just use that as an example. 6 ticks up, you're entered at 35. Okay, so when I say 6 ticks, it's actually 1.5 points that I'm thinking of. But the idea is if you're what is it? Let's just call it 8 ticks. All right, 8 ticks up, you want to be scaling out of a 1 or 2. All right, and that way you get risk-free. Then now you can get into management mode. Now the management mode, you can use the 13 EMA. You can use a trailing stop below the 34 EMA. Okay, and what you want to do is you want to watch the bars back and forth. You want to see, as long as that price is still above a rising 13, and that 13 is still above that 34, we're in real good shape to hold on to the position. All right, as long as that condition applies. So with many of these trades, yes, we like to go for our 2-point rotations in the S&P or 15 ticks or so in the Russell, but there are many instances where, especially in the Russell, where prices will move a lot farther, certainly a lot faster. Okay, so we want to capture as much as we possibly can. I do recommend, even in Russell, to trade with a 2-contract position. Now, let me show you another way. Let me just clear this for a second here. Okay, let me see if I can clear the lines here. Where is that? Okay, clear, erase all lines. Okay. Now the other alternative of entering is using a scaled-in method, all right, rather than all in and all out. So the idea, once again, is, let's use the same example here. So we got our discount here at 1135. Price moves away. Okay, we were not able to get in, as soon as that alert bar, because it moved pretty fast. Price did give us a pullback. So what we want to do is say, if price pulled back here, I want to, again, still buy in that fair value zone. So this is where, as it pulls into the fair value zone, you buy one. Okay, your stop's going to be below the low on that one. And then what you're looking for the market to do is pivot back up and move higher. So what you want to do in this case, all right, now, if you're buying them in the fair value zone, you can use a market order, you can use a limit order. Okay, there's no singular price that is perfect, although you can use the reference price on the alert bar if you're able to. All right, but again, that's a reference price. That doesn't necessarily mean the entry. Now, on your second contract, all right, you can just reference a little bit above the current market and say, okay, if price takes out this line up here, okay, I want to use a buy stop to enter in that price. So you're looking for it to continue higher, and as it pulls back into fair value, you bought one, and then you're looking to add another contract, and yes, we are going to add it at a slightly higher price. Okay, but notice what happens though by adding it at a higher price. Price then, and what we want to reference is that lead line. So that lead line turns up now. Price is above a rising lead line. Okay, so let me just kind of point it out here. Price is above the rising lead line. The lead line is above a 34 that is rising. So this is still, believe it or not, even though the discount fired down here much lower, this is still trading the discount. Okay, so I've gotten a lot of questions about, well, I missed it on the next bar for entry. What I want to suggest to you is yes, we can always try to get it on the very next bar or two, but it's not necessary that we do. And if the market moves away quickly, all right, I want to be able to buy it on a pullback. Okay. Okay. Yeah, but again, so Karen asked, says that she would be hesitant because of the dot firing on the top of the CCI for that second. Yes, but, all right, keep into consideration what is the momentum in price here. The momentum is still higher, okay? So this price has not topped out yet. And as a matter of fact, the signals up here, all right, simply mean that the price has just crossed slightly below that plus 100 line, but it's not the proper configuration for a sell or a short. Okay, we're still within the context of this discount, right, developing and the uptrend. We'll see in another example as it gets much higher to price targets that we want to be a little bit more cautious in exactly what you're saying when there's an opposing signal on the CCI. But don't discount that signal saying, I'm not going to buy it because of that. Remember, you got to evaluate, do we have a strong sloping market in place? Again, my suggestion to everybody, all right, is as you get to know these, this setup a lot more, is nibble. Okay, buy one, nibble a little bit. Again, whether it's Russell or S&P, don't try to tick trade it, because there's too much opportunity in these things than to let it go for 4 or 5 ticks. Okay, which is what, $50? Okay, I understand what it means to everybody, all right, to have a winner, but think about the structure of it, primarily, because there's a lot more to these trades than just 5 or 6 ticks, whether it's S&P or whether it's Russell or crude. Okay, think about it holistically. As I want to buy a particular zone, I want to enter a particular zone. The trade is still valid. Okay, as long as that low bar from the discount, right, that stop point, all right, down over here, as long as that has not been violated, and the momentum direction is still there, there's a lot more potential, for price to go. So even though, again, the blending method, which is what I'm describing, is a little bit, it's actually better to use a blended method because you're not worried about getting the best price. All right, I know many of you want to get the very best price. There is no very best price. I can assure you that. Professionals don't. They're buying, and they're buying here, they're buying there, they're selling here, they're selling there. they're getting an average price on their trades, throughout, all right, the course of the day. A lot of folks I want to get that very best price, okay, and of entry, and I want to get that very best price for exit. There isn't one. What I'm describing for everybody in doing, here today for practical purposes, again, theory aside, the theory is I want to put a buy stop and buy it at that level and get my 2 points or 3 points, nice and clean. The market just does not simply trade that way, all right? The market is not clean that way, okay? The market, you have to, move and groove and be flexible, all right, with, with price, right? Yeah, price level accepted. Again, that's the idea, is you want to make sure that, a zone is accepted, not just one price point. All right. All right, let's move on to the next example here. Okay, we'll move the chart forward here. Let's just move the chart here for a moment. Okay, so on this example here, we just moved the chart over a little bit to take a look at a premium. Now, again, the premium price is at or above the 89. The 34 is below the 89. We got a good down sloping market. There's a directional moving way. These are high probability type trade setups. I mean, they occur fairly with fair frequency, and they offer some very good opportunities. Now, what we want to do here is, again, in a downtrend, same kind of step-by-step process, using your OODA loop, right? Observation, orientation, decision, action. All right, observe, okay, the market direction is down, we got that. All right, we're going to wait for a pullback. Now, as price is moving up, we want to be thinking, all right, where do I want to look to short or enter on a potential premium? So again, as price gets into the fair value zone, all right, we can start thinking pretty much anywhere within fair value is an opportunity to take a short, okay? Now, there are many times where price does not reach the 89, nor does the CCI reach the plus 100 line. Yet it's within the context of fair value now. So though technically that won't be a discount or a premium, but you're in the context of fair value within a larger downtrend. That is still an opportunity to take a trade here. Now, what I want to always suggest here to everybody is to wait for the price to peak, all right, and reverse. Regardless of whether it's a premium or a discount, all right, you want it to peak and reverse, and then you want to be referencing one of these prior bars, okay, and then you want to be using that right side pivot rule, all right, courtesy of one of our members, Rob Ray. So the entry would be as it's peaked, pivoted. In the case of a premium, you'll get the alert bar, and we want to look to aggressively take an entry there. Okay, stop goes above the high. Again, notice that the direction is strong down. All right, the 34.89. All right, they're moving in the same direction. Okay, so this is what we call divergence. They're moving directionally in the same direction, okay, and they're just diverging a little bit, meaning they're just separating, they're widening out, okay. That is a very good looking premium, whether it's Russell or any other contract. This is almost a mandatory type trade where the slope of the moving averages in the fair value zone are aggressively moving down. You get an opportunity for price to retrace a little bit, all right. And again, we're not shorting it on the way up. We're waiting for it to peak, turn, then we short on the right-hand side of that peak pivot. Okay, and again, we have, in this case, we do have the premium signal. Now again, Russell is going to be a fast mover, so you have to be well prepared in advance that you know, in essence, you know where a premium now is going to fire. All right, it's going to trigger at or around that 89, okay, within the context of that fair value zone. And you can anticipate it by watching and paying attention to the fast CCI. If it gets above that 100 line, well, you know at some point it's going to stop and pivot. And as soon as it comes back down through that 100 line, guess what? That signal is going to fire, and you're going to get your premium. So what I was talking about this morning, or this afternoon rather, in the trading room, was that we can anticipate a premium developing. Okay, we don't have to trade it ahead of time, but we can anticipate where and when it's going to, and then be prepared using either a buy stop or a sell stop for entry, or when you absolutely recognize it, take a trade, take one of them. Again, it does not have to be maximum position size, but get something on the book, all right, and then start looking, okay, where would another entry be? Or there are times where you get into one unit. Okay, be it that one contract or several contracts per unit, whichever your position sizing is. There's many times where the price, you don't even have a chance to get in on a second lot, right? Because it moves away so quickly, especially in Russell, right? Well, I call that blackjack, all right? When I can get into a trade and all of a sudden it just moves quickly, 15, 20 ticks, or 8 or 10 ticks on the S&P or something, and because it's on a fast move, I'll just take my trade and say, thank you very much, blackjack. Okay, so we want to help you be prepared, okay, for these trades, rather than always kind of feeling as though you missed them. Okay, in terms of the lead line, okay, the idea here is that you want to be on the same side of the lead line. Okay, so again, this premium was a pretty quick one. Now let's just move along. Price moved down. All right, let's just say we all took our profits on that particular premium. All right, and then price bounced back. Okay, now is this a premium right in here? Well, we don't have a white bar, we don't have an alert bar, nor do we have anything on the CCI. Okay, but yes, it is a premium. All right, so the same thing would apply. All right, and also keep in mind, if you had drawn a reference line at the 11:38.90s there, okay, price on the retrace did not even get back above your original alert bar low reference price, and it's within the context of fair value. So same thing applies, even though there's not a signal. All right, when it stops and pivots, okay, you can look to enter the trade. So what you want to do is, once you get that price below the lead line of the 13, sell one at the market right there. Okay, if it has to be that fast. Sometimes if you have a sell stop or a buy stop, that works as well. Okay, as long as that 13 is continuously below that 34 there, as you can see right in here, okay, it's a good spot to take trades anywhere along kind of that that zone right there. All right, remember, think about the relationship. All right, not the price bars moving up and down like a like a jumping bean. Rather, the 13, where's the price relative to the 13, but where's that 13 relative to the 34? Again, all right, if they're in the proper configuration, all right, there's a higher chance that prices are going to continue directionally, all right, until price reaches some sort of a target level. Now, this is an example of a very good one. This is also an example of a follow-up one that you can still work to get into. Remember, it's not just one trade here, one trade there. A lot of times these are kind of complex type of trades where they give you another opportunity to get in very near to that price point. Okay, so we want to be able to, again, continually take advantage if the directional move, after you've exited the trade, it comes back up, say, hey, I'm going to look to get into another one. Nothing's changed. Okay, I have an opportunity to get back in. All right, but apply the same criteria. Right side pivot rule, add or apply the definition and so forth. Now what I'm going to do here is just going to move the chart over just a touch, and we're going to talk about a premium that did not fully develop, okay, and either didn't develop, or if the trader had taken the trade, probably would have gotten stopped out. Okay, but I'm going to show you the criteria of what we want to use, of whether or not the trade is still what you're looking for. Okay, and it's going to have to do with a couple things. Number one, we're going to look at if price is coming off of a key important zone. So let's just say, for instance, that this is an important zone down here, okay, to begin with, and so price is rallying off that zone. Okay, now what happens is we get a premium signal in here. Okay, is that one to consider? All right, well, if price has already reached a target zone, then again, depending on larger circumstances, the next premium may not be the best to take, and here's the reason why. Not necessarily because it's from that target zone, although that is an implication, but look at the relationship between the 13, 34, and 89 EMAs. Okay, so let's take a look at that. In the earlier examples, look at the configuration. All right, 13 below, 34, 89, and the slope of price action in the fair value zone was fairly steep, wasn't it? You get a move back up off the low here. Look at the 13, 34, okay, now, and the 89. Okay, so this bounce off the low, all right, the relationship, the configuration is all wrong for a premium. The proper configuration is that we have divergence, which means the 34 and the 89, okay, primarily are moving in the same direction. The lead line, we also want to be in general agreement with the 34. Okay, and again, that 13 can cross up a little bit of the 34 and back down and so forth, but we want it to be on the proper side. All right. Notice here, when this premium formed, and again, mathematically, it's a valid premium, mathematically. But is it confirmed? All right. Would it have been confirmed? Okay. Well, what we want to do is we want to use our OODA loop and say, okay, what's the criteria that we use? Well, I want to make sure, is the 13 in agreement with the 34, number one? Since the 13 is our lead line, where's that 13 facing? That's 13 is facing up, right? So 13 and 34 combination is not in the right alignment. So in order to get it in the right alignment, we have to be patient for that to come into the right alignment, right? What's happening to the 89? Is the 89 sloping down or up? All right, the 89 here, let me see if I can grab it. The 89 here is, the slope of it is pretty much flat. So this is not the proper alignment, okay, for a premium. So what we need to do in order to consider this premium as a valid trade, we need to get the proper alignment back in the moving averages. It's not a bar. So somebody had asked me, I'm not sure, was it, do we wait for the bar close or the low or the high? Okay, what we really want is, again, the premium and discounts are alerts to a condition. We need to make sure that we filter each signal properly and make sure that the criteria or the filtration that we use, all right, in relation to the moving averages are on the correct side. Okay, so and this is an example where this probably would not have been executed. All right, we don't want to place a buy or sell stop just immediately underneath that reference bar, because it's not necessary that we do that. All right, although there are times where that's fairly effective, but many times, you know, we have to understand, where are we? Are we coming off an important support zone or a resistance zone? Okay, it's important that we understand that. Okay, so this is an example where the configuration is not correct. The ones examples over here to the left, that's a perfect configuration. That's the one we want to get every time, as much as often as we possibly can. If we end up taking a trade with a not so perfect type configuration, okay, we'll get stopped out. All right, stops do occur. All right, it's not the end of the world. All right, it's part of the process. But if we manage our positions properly, it'll be a small loss relative to those that we end up getting, you know, with some positive alpha. Now, when we have a unexecuted, non-executed, non-valid, non-triggered premium or discount, it generally means that there's a reversal in the works. And most of the time, that's going to be coming off of a key level. All right. This gets us into the stacker trade setup, which is subject of that other Wednesday workshop we did. So that's something that you want to go, you know, view when you have a chance in your studies. But you can see here that this premium didn't develop, never got triggered, wrong configuration, and then price moved up, made a new swing high, pulled back here. The transition started here with the blue cyan bars. CCI now becomes positive on the north side of the zero line. Okay, the momentum has now shifted. Not only momentum, but price structure has shifted bullish. Okay, you can see the crossing 13 here is above the 34 and the 89. Now, the 89 is our proxy for trend on the execution charts. All right, it's really the combination between 13 and 34 that makes a big difference. You want to be always, think about this, you really always want to be in agreement, okay, with the 13-34 combo. Yes, we want to be on the primary side of the 89, because that's going to give us our primary trend condition, right, longs or shorts. Once we have that primary condition identified, we want to always trade in agreement with the 13-34 combination. Okay, so that's going to be you know, part of that filtration system. All right, that I'm talking about. Okay, so you can see here on the shift, the stacker began here. We got a transitional stacker with the blue cyan bars, and then it turned into green as a full stacker condition. Okay, so what you'll see here is the stacker, okay, turned into a discount. All right, and again, apply the discount criteria. So we went from premium, valid premium, to an unexecuted premium, to a stacker, to a valid discount. That's generally going to be the sequence, all right, most often. And so apply the same criteria. All right, price comes down into fair value. Start, you know, speeding up your observation, and you're looking for price to come down at or below that 89, or within the context of fair value. You need to reference the CCI indicator, all right, knowing that if it's below the minus 100 line, you're going to get an alert. All right, you already know what is going to happen before it happens, because you know the criteria. All right, and you know how this it repeats the same sequence every time. And that's the beauty of understanding what any type of trading system. You know that it's a repeatable occurrence, all right, every single time. Again, going through the same criteria in terms of all in and scale out. Okay, you wait for the alert bars and then look to, enter, all right, somewhere within the context of the right-hand side of the alert bar. And then if you want to even, buy them a little bit above that rising 13, okay, as the 13 starts pulling back up here, right? Yes, you're paying up a touch, okay, but it's not really going to be that significant. You're trying to get an average price into at or around that fair value zone. So your goal here is always to try to get a net average price within the context of the fair value zone. All right. Rob asked, is no red on the CCI indication of strength of the move? Yes. Okay. So on the CCI indicator itself, since it's above the 0 line, okay, the blue histogram, okay, again, the blue histogram is going to be the proxy for trend, so that's representative of the 89. So with the blue histogram above 0, you have a bullish trend now in effect. Okay, there are times where it'll touch down right here a little bit. All right, so that just means the price has gone below the 89. That's not really a significant development in terms of the CCI movement. That just means just price pushed down just a little bit below the 89, and then it hooked back up. Okay, so that still becomes a valid trade opportunity here as well. All right. Now let's move the chart, advance a little bit. Let's see if I can find the where we top out. Okay, so this example here, what we're going to look at is again the discount is valid here on the way up. So pull back, all right, into the fair value zone at or below the 89. Okay, so this is a very good one to consider. All right, so the idea here is, again, the idea here is once again buy it into we got it's 5:30 here, so we got the infinity stopping us. You can buy them into the fair value zone, and then notice this little area here, okay, right in here. This is where we want to use that lead line. Okay, so lead line is price is above the lead line, so it's above the 13, sloping up above the 34. This is an area to buy them right in here. All right, don't hesitate. Position size properly. If you feel as though you can't buy a full position because your risk parameter won't allow it, buy at least one contract, okay, so you can get something on board and position size properly. Okay. Now, let's use this example where price moves up. It reaches a key zone. Okay, so this will become a key resistance zone up here. Now, price, once it hits the key resistance zone, a lot of times you'll get 200 extreme readings up here many times. Okay, it'll peak out. It'll get exhausted. All right, and then price will start coming down fairly rapidly. All right, and this is similar to the premium but in reverse. Well, what happens here is this first discount here, we had good momentum to the upside, right? Everybody sees that? Good solid, price momentum, right? Being able to carry price to its price target. Once we've hit a price target, a key level, right, and we get a retracement, many times the price needs to re-energize. Okay, it needs to consolidate a little bit, but mathematically, many times you'll also get the discount, okay, form. So you're getting a discount signal here, okay, and you say, well, mathematically it is correct, it is a discount, but now apply the filter. Filter number one, what's the primary trend doing? Okay, how strong does the primary trend look like? Okay, again, that's going to be the 89. So when that alert bar forms, all right, the 89 is still sloping up, all right, but just not as strong, but still sloping up. Okay, so number one. All right. Number two, what's the 34 doing? Okay, well, at that point, is the 34 upward sloping or downward sloping? All right, well, 34 is downward sloping here. Okay. Now the key is, where is that? So the 89 is used for primary trend. So the primary trend is still up, but price has reached the price target. So intuitively, you should think about the price should pull back a bit, right? Fine. Where with the discount is within the fair value zone, okay. But what's the 13 EMA doing, right? Which is our lead line. At the time of the discount signal, the 13 EMA is sloping down, okay? It has crossed the 34, so it's right now that's not the proper configuration of a discount. Mathematically, it's a valid discount, okay? But it's not the proper configuration. The proper configuration over here, we had good strong momentum, price pulled back, 13 stayed above the 34, 34 was still rising, we had a good rising 89. Here the 89 is flattening out a little bit, okay, and it's actually becomes much flatter here as well. All right, 13 now is below crossing the 34, so recall what I just said of a few moments ago. You want to be on the same side. All right, if you're going to enter a trade, you want to have the 34 and the 13 in agreement. So they're in disagreement here, right? In terms for a long trade. So the 13's crossing down through the 34. That's showing us weakness. That's actually the beginning, potentially, of a stacker trade. All right? What we would need to see, all right, if this was to re-energize, what we would need to see is we would need to see price get back above the 13, but I want to see the 13, okay, let me just kind of draw it here. I want to see the 13 sloping back up like this with the price bars, okay, trading above a rising 13. Okay, does that make sense? Look at the example over here to the left. Okay, that's exactly what we want to see following a discount signal or something to that effect, where the price bars are above a rising 13. 13 is above the 34 in the same direction. That is an opportunity to buy them there, okay, against the low print discount, all right, for the next leg up. So in this case here, this is an example of the wrong configuration, improper configuration, and an unexecuted or failed discount coming off of a key level, all right, eventually turns, unless it re-energizes, which it can, but unless it does, it turns into, all right, a stacker trade, okay, for a reversal. Okay, so what we've gone over here today is we've gone over the basic structure. We've gone over a couple ways of entering, whether you want to use a full entry and then a scale out, or if you want to use a blended method by buying something or entering within the context of that alert bar and then adding to it using the right side pivot rule, which is recommended. Okay, again, using the right side pivot rule, we will be a little bit higher or a little bit lower. Again, we're not trying to get the high or the low, we're trying to get a proper configuration. The goal is to try to get to stay close to or within the context of the fair value zone. All right, that's our safest place to enter. It offers us the best risk reward opportunities there when we enter. We want to use the 13 EMA as a filter line. That's why we refer to it as our lead line. Okay, it's the configuration of the 13 relative to the 34. Okay, that's really important. Okay, we've shown you a couple examples here. The 89 is used for the proxy for trend. Okay, so the proxy or trend, we want to trade always on the dominant side of the 34. And then as you can see here, when we get a shift, all right, in the when we get a shift in the moving averages, when price breaks down through the 89, right, comes back up and retests again that stacker type condition, you can see that the 34 and 13 are below the 89 here, and then all of a sudden price becomes weak and it shifts price structure from bullish, right, to bearish. So we not only have the ability to always trade in agreement with the trend, up or down, we now have the ability to identify, okay, the condition of where discounts are more likely to fail, okay, because of the condition of the relationship of those moving averages. So since the moving averages, as we started the presentation out, is there a consensus of value on the short-term scalper, the intermediate term guy, and the longer-term time frame trader, okay? What the relationship is between those is important, and where price is trading relative to those moving averages, okay, and the slope of those moving averages. So all those conditions, all right, are very important to the success of premiums or discounts. All right. Are there any questions? These are some of the practical applications, going right into the, beyond the definition and showing the definition in action. All right, and how to use them, how to place some orders. Again, you can use buy stops, limit orders, market orders. Okay, your choice on that. Okay, there's not one correct way. I do highly recommend that we do use the right side pivot rule. Okay, because that's important to always consider. That's going to give you the ability to choose an entry price many times in advance by using the position sizing algorithm, as well as your initial stop loss, right? So that's going to be below the discount low bar or above the premium high bars. And it'll tell you, based upon your account size and risk parameter percentage, how many contracts you can end up entering on that. And if you end up entering at a higher price on a discount, all right, you want to keep your risk under control and uniform. So if you're risking, say, $200 or so each trade, that's really what you want to have the parameter of each trade, because if you lose $200, okay, fine, on a busted trade. But the next trade or two or three, you may end up making 200, 300, 400. So it's always about, managing your downside risk. But if we choose these trades, judiciously, with proper discipline, enter, in a very disciplined way, okay, as I've laid out here, it increases your opportunity to have successful outcomes, all right? One thing I do want to definitely, stress on this, okay, is that we do not know, I don't know, nor do you, which ones are going to work, ultimately which ones are going to, fail. Though I've presented to you today that the conditions of those that are more likely to succeed, all right, have the same strong conditions or criteria to them, and those that are more likely to not fully play out, okay, I've also highlighted those. So it's important to understand the distinctions and see what they look like between the two, okay? And so during the day, don't place subjective, well, I don't like what it looks like. Well, what does it look like? Does it look exactly, as we're showing it here? The good ones will, right? The marginal ones, well, has price reached a particular target, and what is the relationship with the 1334? Okay? You need to apply the criteria objectively each and every time, and the more you do it with practice, by sim trading, putting your results down, tracking your results, you will get to know these more and more, okay? and again, you'll get to know whether or not they're confirmed. Okay, they're all valid. Okay, so the validity of it is the fact that it paints on the bar and on the CCI indicator is that mathematically they're valid. But are they confirmed in terms of the criteria? Okay, these are the, this is what we're talking about today. Some of the practical application in the criteria and the filters that we use to identify those trades. Okay, any questions? Okay, if there's no further questions, what I'll do is I'll end the presentation here. So we've gone about 1 hour and 5 minutes. Okay, and again, this is recorded and it will be available in the members area within the next couple days. All right, so thank you for your attendance, and we'll see you at the next Wednesday workshop update.